Hey everybody, Nash here with Benechoice Enrollment Solutions and Technology. I'm going to spend just a few minutes going over the high-level overview of what open enrollment looks like this year. So open enrollment is the time of year where you can make changes to your benefits without needing to have experienced a qualified life event. Once we're through open enrollment, if you do have changes that you would like to make, you need to have experienced a qualified life event to be allowed to make those changes. A qualified life event is going to be something like getting married or divorced or having a new baby or possibly having a child age out. They become adults and get on their own plan. If you do have a qualified life event mid-year, that does allow you to make changes that correspond with what that qualified life event was in our plan mid-year. And what I mean by that is a good example would be, let's say right now you are on your spouse's health insurance, and so you don't need ours. So at open enrollment for us, you waive the health insurance. But mid-year, for any reason, your spouse loses their health insurance, that would allow you to get on our plan mid-year. So that's what I mean by being consistent with what your qualified life event was. If you're newly eligible and you waive coverage, you will need to wait till next open enrollment to get in. And again, that exception would be if you have a qualified life event. Lastly, a lot of the benefits we're going to talk about are guaranteed issue at open enrollment. Some of the benefits we're going to talk about are guaranteed issue at your initial open enrollment. And if you waive them now and you want to pick them up later, there will be evidence of insurability required. So the first thing we'll talk about is the health insurance options we have. We have two options for you here. We have a qualified high deductible health plan that can be coupled with an HSA. We also have more of a traditional PPO plan. So what are the differences? Well, basically with the qualified high deductible health plan, it's less expensive out of your paycheck, but it has a high deductible and nothing but preventive care is covered until you reach that deductible. So you don't have your traditional copays for going to the doctor or getting prescriptions until you have met your deductible. The nice thing with the qualified high deductible plan is it does allow you to set up an HSA account, which is a health spending account. These accounts are tax favored for you when you put money in and when you take money out, as long as you're spending the money on a qualified medical event. Taxes do not come out, so you get a tax deduction when you put money into the HSA. And again, when you're using the money to pay for your out-of-pocket medical expenses, that also is tax advantage. So you have kind of a double tax advantage there. The other thing with an HSA, what's nice is if you're a pretty healthy person and you're not doctoring a lot, the money you put in there every year rolls over from year to year, and you own the HSA. So if you left employment here and you got a job somewhere else, they also have a qualified plan, your HSA goes with you at the exact same amount. If you get to the end of your working years and you're going to retire, maybe you had a lot of money in your HSA, it can then just convert into a retirement account. So HSAs are very cool. It's a very nice way to couple it with the high deductible health plans. So that said, the two options we have here, you'll see on the left is what we call the base plan. That's the qualified high deductible health plan. Your deductible is $2,800 for an individual, $5,600 for family. Below that, we'll see, yes, as we just discussed, you can open an HSA with this plan. You see your out-of-pocket maximum, and then your office copays, telemedicine, and outpatient surgery. You can see after the deductible, you would have a $20 or a $35 copay for primary care versus specialist. Telemedicine and outpatient surgeries are 100% covered after you've met the deductible. If we look on the right, we'll see the buy-up plan has a lower deductible. It's a $2,000 deductible. You may not open an HSA with this plan. You'll see the out-of-pocket maximums, but the big difference here is the $30 and $60 copays are there day one. So you do not have to have met your $2,000 deductible in order to have a copay at the doctor's office. And you'll see telemedicine as well has a $15 copay, and that starts right away. But outpatient surgery, it is 100% covered after you have met the deductible. Continuing with these, we'll see again the base plan on the left. After your deductible, you have copays for lab, x-ray, and advanced imaging. Same with emergency room and urgent care. And you'll also see there are some benefits for pediatric dental. Now that is covered with the deductible waived in most situations, and same for vision for pediatrics. Now the one on the right, you'll see the buy-up plan. The lab and x-ray has a $60 copay, $300 copay for advanced imaging, $300 for emergency room, $75 for urgent care. Both of those copays are waived if you get admitted to the emergency room. And then it works the same on the pediatric, dental, and vision. The prescription drugs are going to be through Express Scripts. Notice that they do not participate with Walgreens. But on that high deductible health plan, again, the thing to remember, and I keep trying to drill it in there, is the deductible has to be met before anything is covered. After that, then you have a $3, $6, or $9 copay. And for generic and for formulary of $55, $110, or $165. And those are for 30, 60, or 90-day supplies. Next thing we'll talk about is the group term life insurance. So all full-time benefit eligible employees here have a base life insurance of one-time salary to a max of $50,000. This is paid for by BeneChoice. You also have a buy-up available where you could buy up to an additional $100,000 on a guaranteed issue basis that you're going to pay for with your own money. So the buy-up coverage is also available for spouse and children. We have two options for dental insurance. Both of these plans cover 100% for preventive care, and that would be your cleanings and x-rays. No waiting period for basic stuff, which is going to be simple extractions and fillings. And then there is coverage for major services like root canals and crowns, but those do have a little bit of a waiting period. You can go to any dentist you want, and this plan will reimburse you directly. If you go to a participating Colonial Life dentist, you're going to get more bang for your buck, and then the plan is going to work with paying the dentist directly. You would just have your copays. The base plan, we'll see the maximum annual benefit that it will pay is $1,000 per person. This has a deductible of $50. That deductible is not applicable to preventive care. So you'll see Class A, we call preventive services, and again, that's your cleanings and x-rays. No deductible, and this covers you at 100%. If you go in for either basic or major services, you have the $50 deductible, and then they're covered at 80 or 50%, and you would pay the difference. The buy-up plan, the only thing that changes is instead of a $1,000 annual max per person, it has a $2,000 max. This shows you the rates for most zip codes. So here in southeastern Pennsylvania, these rates would be correct for us. You'll see an individual is $1,345 for the base plan, $1,404 for the buy-up. So not a lot of extra money, and you have an extra $1,000 in claims that you can have per year. Next thing we'll talk about is the disability insurance. So for short-term disability, BeneChoice pays for a base plan for you that covers you for $400 a month after you've been off for 30 days and would pay you for up to 6 months of being off work. That is a base plan. You have a buy-up available to that where you could actually insure more like 60% of your income. Long-term disability is also offered. This is a voluntary benefit. The employee pays 100% of the cost. That would pick up after you've been off 6 months and would pay you 60% of your income to normal Social Security retirement age. Next few things we're going to go through are commonly known as voluntary benefit enhancements. So these voluntary kind of benefits really gives you a whole menu of things to choose from. That's kind of like a cafeteria style approach where each individual employee can pick and choose different things that they need for their household. These plans are 100% employee paid. These plans are also employee owned, which means any reason you should leave employment, you can keep them at the same cost. Very nice feature. Also, the previous things we were talking about, the medical and dental, those sorts of things, are typically designed to pay the providers. All of these voluntary benefit enhancements are designed that they're going to pay money directly to you. You spend that money wherever you need it. So the first one we'll talk about is the voluntary disability buy-up. So remember, the employer is covering you for $400 a month. This is going to give you the opportunity to buy up to 60% of your income. Now, what's nice with these disability plans is because you pay for this with your own money, taxes would not come out of that benefit. That said, there's a couple of different options when you're looking at a disability plan. You choose how much coverage you want, and you also can choose how many days you have to be off before you're covered and how long benefits would be payable for. Each employee can pick and choose, and that's going to have a direct correlation to what the cost would be for you. So this is showing you a sample rate sheet, which you'll see the rates in your benefit booklet. A couple of different options. The first thing we'll look at on here is on the left-hand side. You'll see a scale for your annual salary, and that will show you your maximum monthly benefit next to that. You can do anything lower, you just can't go higher. And then you'll see a couple of options here, a 6-month benefit period or a 12-month benefit period. So if I had a 6-month benefit period and I was off for 8 months, it stopped paying after 6. So just keep that in mind. And then the waiting period is how many days you have to be off before you're covered. So I could have a 1-week or a 2-week wait. So in this example, I'll see I'm 44 years old. If I had $2,500 in coverage and I wanted the one that covers me after 2 weeks and would pay me for up to 6 months of being off work, that would be $30.69 per pay out of my paycheck. I can move those numbers all around. I just can't go over 60% of my income. So if I looked at my household and I decided I just need an extra $1,000 a month coming in, I can see that would lower my rate down to $1,228. So you have a lot of choices on what you pay for the disability. Disability, by the way, is just available for you as an employee. The next several things I'm going to talk about are available on family. Accident insurance. So accidents can happen to anyone at any time, no matter who you are, what you do. You just never know when an accident's going to happen. That's kind of how those things work. With those accidents that require treatment, there are costs that come up. Not only your deductibles and co-payments, but there can be other things that come up, such as eating out or extra child care or any little number of incidentals that happen. An accident plan is designed to pay cash directly to you in the event of an accident for yourself, covered spouse, or covered children, and they cover a wide variety of things. So in your booklet, you will see the full brochure. I'm just going to hit on some highlights. Initial care. So if you had to use an ambulance or an emergency room, it pays money. Common injuries, dislocations and fractures, stitches, any number of things. They all have dollar amounts assigned to them. Hospital admission. If you're admitted to the hospital, it pays you an admission benefit plus a daily benefit for up to a year of being hospitalized. Then there's going to be follow-up care. So what would be typical is if you were in for treatment and you got released, is you may have physical therapy or doctor office visits at least to make sure you're healing appropriately. Easiest thing to do on this accident plan is just walk through a case study and kind of paint a picture how this would work for our buddy Luke. Luke was cleaning out the gutters. He fell off his ladder. He was taken by an ambulance to the nearest emergency room. They took him in, did an x-ray, and determined, yes, in fact, Luke did break his leg. It was a bad enough break, they needed to admit him and do surgery as soon as possible, and Luke was in the hospital for 3 days. After he was released from the hospital, he had 8 sessions of physical therapy, he had crutches, and he then had a couple of doctor office follow-ups when it was all over to make sure he had healed properly. When Luke totaled up all of his bills, he not only had his deductibles and co-payments, but he had other incidentals that had come up. Luckily, he remembered he had taken out the accident plan. So how this would work, Luke would grab all of his paperwork from the hospitals and doctors, submit them with a very simple claim form to Colonial Life, and they would pay cash directly to him. So in this example, we can see for Luke, it paid him $250 for the ambulance trip, $125 for the emergency room, $40 for the x-ray, $1,250 for the admission. He was in for 3 days. It paid him $300 a day for hospital confinement. His leg was worth $2,500. Physical therapy, medical equipment, doctor office visits. Total it all up, Luke got a check from Colonial Life for $5,715. Well, that certainly helped him cover his deductible and he had some money left over to help out with, again, the incidentals that come up. So that's how an accident plan works. They're very inexpensive. There is a low, medium, and high plan. That example, I believe, was on the higher plan, but this shows you employee only. Biweekly is $822 a pay for the middle of the road plan. So not a very expensive plan at all. Next couple things we'll talk about are cancer and critical illness insurance. So there's hardly anyone around that doesn't know someone who's went through cancer, heart attack, stroke, all of those different things. And hopefully you'll never have to go through it, but we do see when people are going through it, the last thing they want are financial burdens. So that's where the cancer and critical illness plan comes into play, is they are designed to dump cash on you if you're fighting any of these illnesses. You spend that cash wherever you need it. The cancer plan we'll talk about a little bit, and just like the accident plan, there's a ton of different things in here. This is just going to give you a very high level overview, but it pays benefits for every day you're receiving radiation or chemo, anti-nausea, hospital confinement, second opinions, health care, experimental treatments, traveling, lodging, family care. One thing I always want to point out is it has a $100 wellness benefit for your routine cancer screenings per person per year. So if you know you go in every year for your pap test or a mammogram or a PSA, keep that in mind when you look at the rates. This is going to pay you $100 once a year to have that done. This shows you an idea of some of the rates. There's actually 4 levels of coverage available. Level 3 is the one we do the most of, but you can see that would cost $12.30 per pay. You can even do the lower option, which covers you for $8.35, or would cost you $8.35 per pay. All of these plans cover exactly the same things. It's just going to be the dollar amount that they're paying to you goes up and down depending on which plan you're in. So that's how the cancer plan looks. The next one is the critical illness. So it's the same concept, but it works a little bit differently. The critical illness plan, you choose a face amount like you would a life insurance policy, and then if you have an initial diagnosis of a covered critical illness, such as heart attack, stroke, end-stage renal failure, major organ failure, or blindness, it's just going to pay you the face amount. So if I bought a $10,000 critical illness plan, I had one of those things happen to me, I would get a check for $10,000. It's very simple. This plan also has a $50 wellness benefit once a year. So the cancer plan had a $100 wellness benefit. The critical illness has a $50 wellness benefit. This shows how this would work for a biweekly non-tobacco user. So again, for me, I'm 44 years old. If I wanted a $10,000 benefit, it would cost me $5.05 per pay. The cancer nor the critical illness do the rates increase as you get older. So you lock your rate in when you get into it. Okay, last thing we're going to go through are a couple of different life insurance options. We spoke earlier about the group life you have available that is both employer paid and the buy-up. Those are great options, very inexpensive, but they're not designed to be kept if you leave employment here. These voluntary benefit enhancements, remember, anything that we're talking about here are portable at the same cost. That's very important with life insurance because life insurance, just by its nature, gets more expensive as we get older. So the life insurance plans I'm going to talk to you about now, you have 2 options, and you can do one or the other or a combination of the 2. Is a true life insurance plan. So it is designed that when you pass away, it's going to pay money to whoever you designated as your beneficiary. They're going to use that money to cover your final expenses, funeral costs, medical bills, maybe the mortgage, kids' college, whatever they may need. But that said, there's 2 different kinds of these individually owned life insurance. There's term life insurance, which is the least expensive. It is designed that you lock your rate in for a term of 10, 20, or 30 years. At the end of the term, the policy essentially expires. If you want to renew it, you may do so, but you are now 10, 20, or 30 years older, so it's going to be more expensive. The idea behind these 10, 20, or 30-year term policies is you're going to look at your own household situation and get an idea how long you need the coverage for. So if I have young children, I'm going to want at least the 20-year term because I'm buying the extra life insurance. God forbid something happens to me and I'm not there to provide an income, the life insurance is going to replace that. But I don't need it forever. I need it until that child is an adult. Same with if I have a mortgage. So term insurance is good for financial exposure you have that goes away with time. That's good for term insurance. The other kind is whole life insurance or permanent life insurance. It is more expensive today for the same amount of coverage, but the big difference is you lock your rate in and your rates never go up. So if I'm 44 years old today and I bought a 20-year term life plan, when I'm 64, it expires. And now if I wanted to renew it, it would be really expensive. The whole life insurance plan, same thing. I'm 44 today. I buy it. When I'm 100, I still have it at the same cost. My rates never go up and my benefits never go down. Whole life insurance is also the kind that builds a little bit of cash value. I don't typically spend a lot of time harping on the cash value because I don't want you to get confused and think of it as some sort of a retirement account. The cash value builds very slowly, and you're not going to make money on it. That said, if you did pay into it for a while and you decided you didn't need it, you could cash it in and get part of the money back out of it. So let's look at the rates just to give you an idea. On the term plan, we're showing you a 10 and a 20-year example, non-tobacco and tobacco. And we'll see the non-tobacco, if I wanted a $50,000 policy, and let's assume I was 40 years old, it would cost me $648 per pay. That is locked in for 10 years. If I wanted to do the 20-year term, I can see that same $50,000 in coverage would only cost me $712 per pay. Now I've locked that in for 20 years. I'm guaranteed that rate doesn't go up. The other thing the other kind we were talking about was the whole life insurance. This shows you the options here is that you have a plan that's paid up at age 100. That same $50,000 in coverage is $29.25 per pay. So it's quite a bit more expensive, but this plan does not expire when I turn 65. I can keep this forever. The whole life plans also have options for children and grandchildren, even if you don't take it out on yourself. So keep that in mind as well. You may be all set on life insurance and don't need any for yourself or your spouse, but maybe you have a child or a grandchild you'd like to get something started for. Very inexpensive, and you're also locking that rate in. So when the child turns, of legal age, you can assign it to them and they can take it over at that point. Okay, so what happens next? So take the time to review what's in your information. Certainly come to us and ask questions. This is an active open enrollment, which means you must accept or decline each benefit. Remember, some of the things we were talking about are guaranteed issue only as you're newly eligible to enroll in them. Meaning if you waive them this year and you want to pick them up next year, there can be health questions. So get with your manager to find out locations and dates that we will have benefit counselors on site. Again, we are going to meet with every employee and get an accept or a decline. Obviously, be there to answer your questions. For those at remote locations, we do have a call center as well. So again, get with your supervisor and we'll figure out the best time to get with you. So thanks so much and have a great day.